Right now, macroeconomic headlines are driving retail investors to exit their positions at an aggressive rate. Fearful of a broader downturn, the crowd is moving toward the perceived safety of cash. This style tracks the Fear and Greed Index. At 22 points, it indicates that current market sentiment has reached the level of extreme fear. Under normal conditions, this volume of selling would cause the price to drop without resistance. However, the data shows a different outcome. Sliding towards $60,000, the price hit a decisive rebound and is holding steady above $64,000. This downward pressure from retail sellers is met by an equal volume of buy orders. That $64,000 floor suggests a significant entity with deep capital reserves is systematically absorbing the assets being sold by the public. To identify who is taking the other side of these trades, we have to look past the sentiment and analyze the underlying ledger data. This ledger shows that while retail investors were selling, institutional whales were executing large-scale purchases. They acquired over 125,000 Bitcoin during this period of high volatility. Following this latest round of buying, these institutional entities now control 35% of the total circulating supply. Unlike traditional currencies, this asset is bound by a fixed supply. The software prevents any additional units from being created to meet rising demand. Central banks can issue more currency, and companies can dilute their shares, but this supply cap remains static regardless of market conditions. When institutions remove 35% of a fixed asset from the market, the remaining liquid supply available for public trading begins to shrink. These entities are engineering a structural shortage by consolidating a significant portion of the active supply into private holdings. This strategy is being integrated into the regulatory and technical infrastructure of the financial system. The stablecoin issuer Circle recently secured a U.S. National Trust Bank charter, a significant step towards institutional integration. This charter provides the regulatory framework necessary for major tech and finance firms to interact with digital assets on a long-term basis. Public markets responded immediately to this news, sending Circle's related stock up 13%, even as the broader crypto market faced selling pressure. This banking infrastructure serves as a mechanism for long-term storage, allowing accumulated assets to be held in regulated, institutional-grade vaults. This massive shift moves a growing percentage of the supply from liquid public exchanges into private institutional custody. The combination of institutional accumulation and new banking infrastructure is creating the conditions for a supply shock. As this model shows, a supply shock occurs when returning market demand attempts to pass through a severely restricted bottleneck of available supply. When the current macroeconomic uncertainty fades, retail demand typically returns to the market in a concentrated wave. Because so much supply is held in institutional vaults, returning buyers will find very little available. This imbalance creates a price squeeze. With demand high and liquid supply low, competition forces the price upward. The data suggests that while the public saw a market crash, institutions saw an opportunity to move assets into long-term concentrated holdings.